Hi, welcome. In this session, we're going to take the data descriptives we talked about, at least in the abstract, in the last session, and make it real by looking at applications in investing and finance. I'm going to start by looking at returns on three different asset classes that investors tend to follow. The first is US stocks, the second is a 10-year Treasury bond, and the third is a T-bill. In this graph, here's what I've done. I've computed the percentage returns you'd have made each year from 1928 to 2020 on each of these asset classes. You're saying, how did you get returns? Let me start with the easy one. With T-bills, I looked at the T-bill rate, and since with T-bills there's no price change, you just hold it for the year and get the return at the end, I looked at the rate of the T-bill as the return on a T-bill. So that was easy. For T-bonds, it was a little messier. On T-bonds, there are two components to your returns. One is the coupon you're promised at the start of each year. But remember, it's a 10-year bond, so if interest rates change during the course of the year, the T-bond price can go up or down. So I computed the price change in the T-bond. And a little later in these classes, we'll talk about how to compute that price change. But I computed the total return as the coupon plus the T-bond price change. For stock returns, again, I looked at two components. The first is the dividends you receive on stocks, and of course, the change in the price during each year. Now, already you can see, looking at this graph, that stocks have been by far the most volatile of these three asset classes, followed by T-bonds, and T-bills are the most stable. Now, let's see if we can use descriptive statistics to eke out more information than what we get by just looking at the chart. So let's turn to the descriptive statistics. Let's start with the average returns. Between 1928 and 2020, the average annual return on stocks was 11.64%. How did I get that? Well, I just added up the returns on stocks every year from 1928 through 2020 and divided by 92. So that was pretty straightforward. It was the average return. Actually 93. In fact, the reason it's 93 is you start with 28 and you can check it out. It's 93 years. For T-bills, I added up the returns every year divided by 93, 3.36%. T-bonds, 5.21%. Now, if I just stopped there and said, which of these asset classes would you like to invest in? Based purely on average returns, this seems like a no-brainer, right? Stocks earn higher returns than T-bonds, which earn higher returns than T-bills. But here's the catch. Stocks are riskier. Well, one way to see the risk is to look at the standard deviation. How did I compute the standard deviation? I took each year's return on stocks, subtracted out 11.64%. Remember, you subtract out the average, squared that number, and added up those squared numbers across the 93 years. And then I divided by 92. You're saying, what happened? Why did I lose it? Remember, this is a sample. It's not the whole history of stocks. I lost a degree of freedom. That's how I got the 19.49%. With T-bills and T-bonds, I did the same. And already you can see why picking an asset class is not simple. Stocks have the highest average returns, but they also have the highest risk, highest standard deviation. T-bills have the lowest returns, but they're also the safest investment class. Now, if you take the standard deviation of 19.49% and convert to a standard error, and remember how we convert to a standard error, you take the 19.49% and divide by the square root of 93, the number of observations in your sample, you get a standard error of 2.02%. Let's pause right there, saying, what does that tell me? Well, if I assume the future is going to look like the past, and you ask me, what will returns on stocks look like next year? With the big caveat of the future looking like the past, I could tell you with 67% confidence that my returns are going to be somewhere between 9.62%, that's 11.64 minus 2.02%, and 13.66%, which is 11.64 plus 2.02%. That's with 67% confidence. Saying, what if I want 95% confidence? Take 2 times the standard error, 4.04%. Add that to 11.64, that'll give you 15.68%, and subtract out from 11.64, that'll give you 7.60%. You get a confidence interval for 95%. I know I went through those numbers quickly, but all I'm doing is taking the average, adding 1 or 2 standard errors and subtracting 1 or 2 standard errors to get the ranges. And the standard error tells the same picture as the standard deviation. It's much smaller. I can make more precise predictions about T-bills and T-bonds than I can about stocks. Now let's look at the median. Remember again, the median is the midpoint of your sample. Since I have 93 years of data, if I rank them, it would be the 47th observation. The median return for stocks is 14.22%. Half of all stock returns, annual stock returns, were higher than 14.22, half were lower, but already you can see the median return was actually higher than the average. Now remember, the reason the median and the average diverge is because you have asymmetry. And because the median is higher than the average, you can pretty much guess that the asymmetry is going to show up as negative skewness. At least with annual stock returns in the US, you have a slightly negative skew, which is you're more likely to get extreme negative observations than extreme positive ones. So the negative skewness leads median to be higher than the average. But if you look at T-bills and T-bonds, you see the opposite happening. Why? Because those distributions tend to be positively skewed. Now the kurtosis of a normal distribution is 3. Now if you look at the kurtosis for stocks, it is surprisingly close to 3. At least looking at historical returns, even though there's a slight negative skew, the tails of the distribution don't show any problems in terms of rejecting the normal. It looks pretty much like a normal distribution in terms of the tails. With T-bills and T-bonds, you get more positive kurtosis, which basically means that you get a greater chance of these extreme values relative to the settler value. Now, if you look at the minimum and the maximum, that's the worst year for stocks in those 93 years was a minus 44% return. The best year was about a 53% up year. You take the difference between those two numbers, you get a range of 96%. Again, how would you use the range? You make comparative statements, and it tells the same story that the standard deviation did, which is stocks are much more divergent, much more volatile than T-bonds, which in turn are much more volatile than T-bills. In fact, there's an alternate measure of range I can use where I take the 25th percentile. That is, if I rank the 93 companies, it's a 25th percentile, which is minus 1.19%. 75th percentile is 25.06%. The difference is 26.25%. That's the interquartile range. And guess what? It tells the same story as the other measures of dispersion. So what have we learned by looking into these 93 years? At least over the 93 years of data that I've shown you from 1928 to 2021, stocks have been the best performing asset class of these three. They've also been the riskiest asset class. Stocks are close to normally distributed, though they have a slight negative skewness. But T-bills and T-bonds both have positive skewness and more likelihood of outliers than you would expect to see in a normal distribution. The ranges, whether they're traditional ranges or interquartile ranges, back up the notion that stocks are riskier than bonds and bonds are riskier than bills. So let's move to a second example. You've heard of PE ratios, right? You take the stock price, you divide by the earnings per share, you come up with the PE ratio. It's one of the most widely used metrics in investing. Traditional value investors argue you should buy low PE stocks. Now, I'm not going to go down that road and talk about what to invest in. But at the start of every year, and I've done this for about 30 years, I compute the PE ratio for every stock. In the US and global, this is a graph of just US stocks at the start of 2021. And I've computed 3 different PE ratios. So how can you have 3 different PE ratios? The stock price is the same in all 3 ratios, but here's why you have a difference. I could divide the stock price by the earnings per share in the most recent fiscal year, which in January 2021, the most recent fiscal year for many companies was 2019 because the 2020 numbers hadn't come out yet. That's called current PE. I could divide by earnings per share in the last 4 quarters, which would be from October of 2019 to September of 2020 for many companies. That's called trailing PE. Or I can divide price per share by expected earnings per share in the next 4 quarters, which is called forward PE. Now, we'll have plenty of time to delve into why we have 3 different metrics and which one is the most reliable, but let's just look at the data. This is a distribution of PE ratios across companies. Now, the earlier distribution we looked at for stock returns was across time. This is across companies. It's called a cross-sectional distribution. Take a look at this. This is called a histogram, where I've counted the companies, and you can already sense what you're going to see when you look at the data descriptives. On all 3 measures of PE, you've got a peak to the left and a tail to the right. What does that mean? Well, these distributions are definitely not symmetric. They're positively skewed. And when you look at the descriptives, you see the results almost immediately. The average PE for US stocks, if you look at current PE, is 110. In fact, it's a really high number no matter which measure of PE you look at, 110, 103, 80. But before you freak out and say, that's a really high number, the median value is much, much lower. For the current PE, the median value is 18. Again, there's no mystery about why this happens. You know the lowest value a PE ratio can take? It's 0. You cannot go below 0. You know what the highest value PE ratio can take? Who knows? In fact, in this sample, there was one company with a current PE of 36,000, one with a 25,000 trailing PE, and one with a 42,390 forward PE. Think about it. You floored the PE ratio at 0. Your highest number can be 10, 20, 30, or in this case, 42,000. Well, the average is going to get pulled out by those outliers, even with big samples. What does that mean? It just basically means you cannot trust the average as a reliable indicator of where stocks are now. A median is a more sensible measure because these are asymmetric distributions. Now, if you're interested in more distributional statistics, I've computed the 10th percentile and the 90th percentile. I'll be quite honest, I find looking at the minimum and the maximum too constricting because they're the extreme, the most extreme of extreme values. I think it makes more sense to look at the 10th percentile. It's also called the first decile, or the 90th percentile, the 9th decile. And you can see that PE ratios have a big range. That's why when somebody says the typical PE ratio in the US market is 18, you've got to take that with a grain of salt. There's a huge amount of dispersion in the data. So just because a stock trades at 70 times earnings doesn't mean it's overpriced. You have to look at other factors. Which brings me to a third distribution. Cost of capital. And if you've never seen a cost of capital before, is what companies use as hurdle rates. It's what they use to decide whether projects are good and bad. And basically it reflects their cost of raising funding from equity and debt. So without going to the mechanics, I compute the cost of capital in US dollars for all publicly traded companies at the start of every year. And in this distribution, I've put up a histogram. And this is something we're going to come back to. Histograms are always my starting point for depicting data for both US companies and global companies. Again, you have a little bit of a positive skew in the distribution, but not as pronounced as the PE ratio. But you see, for instance, that there are a lot of companies, and in fact, with global companies, with US companies, you have quite a few companies with very low cost of capital. So some of this might just be the way I drew the histogram, but clearly the data here is much more difficult to decipher than PE ratio data. So again, look at the descriptives, and let's start by looking at the average and the median, those measures of central location by region of the world. If you look at African and Middle Eastern companies, and you can see I'm working with very big sample sizes, 2,245 companies. The average cost of capital across companies was 6.69%. The median was 6.27%. And if you go across the world, you can see it cuts both ways. Some parts of the world, the average is higher than the median, which tells you that the skewness varies in different parts of the world. There's some parts of the world where you get a positive skew on cost of capital, some parts of the world where you have negative skew. I was able to get the cost of capital for pretty much every company, so I did not lose any companies in my sample. In fact, before I forget, let me go back a couple of pages to the PE ratio data. I told you what the distributional statistics look like for PE ratios, but I held back on something that I should have told you that should make you think twice about using these metrics. There were 7,584 publicly traded US companies at the start of 2021. When I computed current PE, I was able to compute them for only 2,780 companies. Saying what happened with the remaining 4,800? You know what happened? If the earnings for a company are negative, the PE ratio becomes not meaningful. I had to throw those companies out because I could not compute a current PE. Same thing with trailing PE. If the earnings were negative, I threw them out. With forward PE, I had to throw out not just companies with negative forward earnings, but also companies where I couldn't get that forecast because somebody's got to make that forecast. The bottom line is, I'm losing almost 2/3 of my sample, no matter which measure of PE ratio that I use. And you're saying, what's the big deal? You still have a lot of companies? Well, the 2,780 companies I end up with are not randomly picked from my sample. It's a biased sample. It's a biased sample with the biases towards healthier, more mature, older companies. I'm losing a lot of young companies, growth companies. We talked about how sampling bias can creep in the most subtle ways, and you can see it show up there. Now, one additional table that I created for my cost of capital calculation, and this is to back up what I said earlier about providing distributions that provide a fuller picture than this minimum and maximum, is I computed the first decile, the first quartile, the median, the third quartile, and the ninth decile for companies. You know how I find this useful? When valuing companies or in doing corporate finance, we often spend a huge amount of time estimating cost of capital. And I often push back saying, should we be spending so much time on this measure? And people say, look at me like, no, why shouldn't we? It's a big number. You know why I wouldn't spend too much time finessing the cost of capital for a US company? Take a look at the median US company. It is a 7.4% cost of capital. 50%, half of all US companies have cost of capital between 6% and 8.25%. Think about that. You're spending all this time on a number that half of all companies fall between 6 and 8.25. 80% of all US companies fall between 5 and 9%, or 4.8 and 9.15%. Now in valuation, I suggest to people that they don't sweat the small stuff. And then I say the cost of capital is often the small stuff. It's not the number where you're going to get a huge mistake because the ranges are pretty tight. And that's what having the distributional details allows you to do, is decide which variables you should be focusing your time on. Which brings me to my final data item that I want to look at in terms of both distributions and metrics. You know what a dividend yield is? You take the dividend paid by a stock and divide by the stock price. So if I pay a $2 dividend, I have a $50 stock price, my dividend yield is 4%. You're saying, why would I care? If you invest in a stock, this is the portion of your return that comes from dividends. And because dividends tend to be stable, they're the more predictable portion of your returns. So again, for a lot of value investors, one of the criteria they look for is a high dividend yield. Again, I'm not going to pass judgment on whether that's a good strategy or not. In this table, I've looked at both global and US companies and looked at the dividend yields among dividend paying companies. That sounds like a strange qualifier, but you're going to see in a minute why I do it. So I take the dividend yield for every company that pays dividends and I put up a distribution. Now this is a very different distribution than the distributions you've looked at before. In fact, the peak of this distribution seems to happen all the way towards the right. There are more companies that pay less than 0.5% in dividends globally than there are companies that pay 2 or 3 or 4% dividends. Now, if you look at the distributional characteristics, there's some interesting things that jump out. The average dividend yield for a US company in 2021 or 2020, which is when the dividends were paid, was 1.04%. You say, that's awful. That's a really low dividend. It is what it is. But you know what the median dividend yield for a US company was? It was 0%. You're saying, how can that be? Remember when I showed you the chart on the previous page, I said these are the dividend yields among companies that pay dividends. 74% of US companies in 2020 paid no dividends. their dividend yield is 0. So here's a nice trick question to ask somebody who acts like they know it all. What's the median dividend yield for a US or a global company? The right answer is actually 0%. You'll almost never get that answer back. Now, it's true, if I focus only on dividend-paying companies, I get very different numbers. Among dividend-paying companies, the dividend yield for a US company is 4%. The median is 2.43%. So let's say I came to you with a dividend-paying company with a 1.5% dividend yield. Now, part of you says, that's a good dividend yield. Look, it's higher than the average. Well, I don't think you should be comparing the 1.5% to all companies. You should be looking at only dividend-paying companies. And looking at dividend-paying companies, 1.5% is on the low end of the spectrum. It's less than the median. So again, the reason we do descriptive statistics is to make decisions. And I'm suggesting that the way we slice and dice the data can sometimes alter those decisions. So I hope you found this session on data descriptives useful, and thank you very much for listening.